Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me as always is Shruti Mishra. These are the top headlines that we're tracking for you this evening. The ban on real money gaming industry is likely to impact India's fintech players. Sources say money games accounted for up to 20,000 crore rupees in monthly transaction volumes. Data shows more than 351 million transactions were processed via UPI alone in the month of July.
Global travel tech firm OYO plans to file its DRHP in November, eyeing a $7 to $8 billion valuation for its IPO, says sources. The company expects to approach its board with a proposal next week. Sources add discussions with key banking partners have ramped up in recent weeks.
Fintech platform Kiwi backs $24 million in a Series B funding round led by Vertex Ventures. Nexus Venture Partners, Stellaris Venture Partners and Umidyar Network also participated. Will use the fresh capital to accelerate Kiwi's growth journey, advance its product roadmap and sharpen its focus on building sustainable unit economics.
Manufacturing tech firm Groyo turns PAT positive, eyes 900 crore rupees in revenue in FY26. The company, which supplies to global giants like Zara and Mango, projects 25 crore rupees profit before tax on the back of strong exports and AI-led design solutions.
ChatGPT maker OpenAI appoints Raghav Gupta, the former Asia-Pacific MD at Coursera, as the head of its education vertical for India and APAC. The company plans to launch its first Indian office this year. OpenAI is introducing India-specific programs, including a learning accelerator with IIT Madras, AICTE, and the Ministry of Education. This evening, but at the top story today, fantasy sports platform Dream11 will no longer sponsor the Indian cricket team. The company has informed the BCCI that it will not be able to continue its partnership. The Indian team is currently without a title sponsor with just a fortnight left for the Asia Cup in the UAE. The BCCI will issue a fresh tender for sponsors shortly. However, Dream11's exit will not attract any penalty. This, as the sponsorship contract includes a clause exempting liability if the sponsor's core business is impacted by new government regulations. Dream11 has shut down all its paid gaming contests after the Parliament passed the online gaming bill. The bill prohibits online money gaming services, advertisements and financial transactions related to them. The government has cited psychological distress, financial loss, money laundering and even financing of terrorism as reasons for the ban. So how will the prohibition on payments hit the fintech sector? Ritu Singh joins us with all of those details. Ritu?
Well, the fintech sector could feel the second-order effect of the government's ban on real money gaming, with a chunk of the monthly transaction volumes being handled by these payment companies. It's a business that many fintechs chase for higher margins and scale. Now, our sources indicate that this sudden halt can wipe out anywhere between 14,000 crore rupees to 20,000 crore rupees in monthly payment volumes across all players and platforms. A bulk of these payments were typically through UPI, as much as 60-70% or even more, and the rest through cards, net banking, etc. In fact, if you look at the latest public NPCI data, it points to 351 million gaming-related UPI transactions worth more than 10,000 crore rupees in the month of July alone. Now, in terms of who is most exposed, our sources say Cashfree, PayU, EaseBuzz, these are some of the key players in the segment, and the likes of Razorpay, for instance, have a smaller share of the pie. But all of these companies in their statement to us claim that real money gaming was a small share of the portfolio and hence the impact is not significant. A Razorpay spokesperson, for instance, said their exposure is about 500 crores in monthly gaming transactions, and given the diverse portfolio, the overall impact is negligible. PayU again says gaming is a minor portion of the business, calling the overall effect non-existent, and Cashfree Payments said that real money gaming was a very small proportion of the overall volumes. Now, to put this in perspective, as these players are saying, UPI processes over 25 lakh crores of payments monthly. So as a proportion, yes, this amount is not much, but with nearly 20,000 crores of monthly payment volumes disappearing overnight, the ban will leave a mark on the broader payment ecosystem, even if no single player admits to being hit hard.
Well, thank you, Ritu, for those details. Appreciate you joining us. Moving on, generative AI native autonomous medical coding platform for healthcare providers. Arintra has raised $21 million in Series A funding. The round was led by Peak 15 partners with participation from Endeavor Health Ventures, Y Combinator, Counterpart Ventures, and other strategic investors. Now, the fresh capital will fuel Arintra's nationwide expansion across health systems and physician groups, accelerate product development and support a new Bay Area headquarters to meet rising demand. Joining me now is Nitesh Shroff, the co-founder and CEO of Arintra. Nitesh, welcome to Startup Street. You've described healthcare reimbursement as fundamentally broken. What exactly is broken in the current system, Nitesh, and how big is the problem that you're solving?
Thanks for having me here, Shruti. So in US, when we visit a doctor, it's the insurance companies that pay for the bulk of this for this visit. And interestingly, the onus is on the hospitals to file this insurance claim. And the key step in this is called the medical coding, which basically translates clinical notes into medical codes. And that's what determines how the hospitals will get paid. Will they get paid, and at what time will they get paid? Today, hospitals are spending more than $40 billion just to get reimbursed. They're actually getting paid 30 cents for every dollar they are actually invoicing, right? This is because one of the key reasons is because the manual coding step is very, very expensive. So insurance companies are finding more and more ways to deny their claims. So that's the key problem that we are trying to solve. And we are using Gen AI to automate this step of converting medical notes into clinical codes. And this helps hospitals get paid better, faster, and more accurately.
All right. But you know, Nitesh, medical coding has been around for decades and several players already automate parts of the process. So tell us what makes Arintra's approach different. How do you integrate with existing electronic health record systems like Epic and Athena without disrupting workflows?
Yeah, so we made 3 design choices. One is that, hey, we started with actually one of the most complex areas of medicine, which is basically the broader internal medicine, right? Basically, everything that happens to you, the first doctor that you go to is typically your PCP or the internal medicine, which means the breadth that needs to be covered is a lot more, and that actually makes it very, very complex. And that has helped us move very, very fast across other areas of medicine. The second design choice has been for us to deeply integrate with basically 2 of the top EHRs, or the Epic and Athena. So our users actually find Arintra as almost like an invisible medical coder sitting inside their EHR. So that's the kind of seamless experience we give our customers or our users.
Okay.
The third
go ahead.
Actually to build on this revenue assurance, basically where the idea is to continue expanding into this and make sure hospitals get paid accurately and timely through our approach towards revenue assurance.
All right, Nitesh, you just said you're not just automating, but reimagining revenue assurance for hospitals and physician groups, having already processed over $1 billion in healthcare charges. If you could share with us some of the concrete results your customers have seen.
Yeah, through Arintra platform, we have processed more than $1 billion worth of claims, and we are continuing to increase this. We have delivered more than 5% revenue uplift for most of our customers. We have been actually reducing the denials rate by actually almost half, and also making sure they're getting paid at a 32% lower cost.
Okay, all right. Coming to the fundraise now, Nitesh, walk us through your deployment plans. What's the focus as you expand nationwide and set up your new Bay Area headquarters?
Yeah, this funding we are using to actually scale our impact and deploy Arintra at more and more health systems and physician groups across the country. Build more of those area of specialties, area of medicine like inpatient rounding and several other specialties, and build a new Bay Area office to actually attract top-notch talent here.
Okay. Arintra's platform promises to tackle the twin challenges of coding accuracy and payer denials while cutting costs as well. So tell us, Nitish, AI in healthcare also raises questions around compliance and, explainability. How do you ensure every code generated is both trusted and auditable?
Yeah, this was one of the fundamental choices we made on day one. Every code that Arintra generates is actually directly tied to where in the documentation it was mentioned, or where in the document, in the clinical documentation, where the conditions were described or mentioned. And then we also present a decision matrix to our users, where they can verify exactly why a claim was coded in a certain way. Very, very interestingly, this was actually the first version of this was actually the internal debugging tool that we developed for ourselves. And then over time, we immediately realized that hey, this is actually equally useful for our customers, and that's how we have actually exposed that to our users, so they can verify and trust every code that Arintra generates, and that has been game changing for us.
Okay. One final question, Nitish, before I let you go. The healthcare reimbursement industry is a $150 billion market. Where do you see Arintra in the next 3 to 5 years? And what's next on your product roadmap beyond coding and revenue assurance as you look at the broader healthcare value chain?
Yeah, our first and foremost goal is to ensure that hospitals get paid accurately and timely for the services they are providing, right? And that too in a cost-effective and in a compliant manner. This is the vision towards which we are continuing to build. But moving beyond that, very interestingly, our input data is clinical data and our output data is financial data. So we actually have deep insights into both the clinical data and the financial data. So this is what we are actually leveraging to handle more and more of the administrative work for the hospitals, so that they can primarily focus on the care, on the patient care. So that's where we are.
Okay. Well, on that note, it's time for me to wrap up our conversation. Nitish, many thanks for joining us on Startup Street today, and wish you the very best with all the future plans that you just mentioned.
Thank you, Shruti.
Moving on, Eyestem Research has raised $10 million in an oversubscribed funding round to advance its pioneering retinal cell therapy, Eyesight RPE. The Bengaluru and Delaware-based biotech company will use the capital to complete its phase 2 clinical trials in India and prepare for an IND filing with the US drug regulator. Early trials for patients with dry age-related macular degeneration, a leading cause of blindness, has shown promising improvements in vision with no serious side effects. Backed by strong investor confidence, Eyestem is now positioning itself as a global leader in cell therapy with the potential to redefine treatment outcomes for millions. Joining me now to discuss this further is Jogan Desai, the founder and CEO of Eyestem. Jogan, thank you so much for taking time out and being here with us on Startup Street. Eyestem has just raised $10 million in a heavily oversubscribed round. If you could sort of tell us what it is that you do at Eyestem and what will be the key priorities for deploying this fresh capital?
Yeah, thanks for having me here on Startup Street. See, what we've done is taken a long-term bet on the direction of medicine that is going to happen over the next 10 years. We believe that in the next 10 years, a lot of diseases that are currently incurable will start becoming treatable. And we will need there is a huge need for those incurable diseases to be treated at prices which what I call the bottom 99% can afford. So we've started with the Eyesight RPE for dry age-related macular degeneration. It's the largest cause of incurable blindness for people above 50 globally. There's no cure that can reverse vision loss, and we are, as you said, we've seen some fantastic results in our phase 1. The money goes towards 2 or 3 things. One is obviously completing our phase 2 in India, so getting to an IND in the US, and creating a platform from which a virtuous product cycle can emerge, which can lead to our 10-year strategy.
Sure. You've completed phase 1, as you pointed out, with encouraging results, and you're preparing for phase 2, right? So what makes Eyesight RPE stand out compared to other global clinical trials in this space?
So we've got 2 main competitors in this space. One is Roche, who bought out a company known as Lineage Therapeutics, and the other is Astellas, which recently announced some results. We believe as of now, in science, data speaks, right? Everything else it doesn't matter. So as of now, our phase 1 data has a significantly better safety profile than everything else that is reported. And in efficacy, we are a little bit better. So we're hoping we can capitalize on that during the phase 2. One of the things that we've done really well is figuring out the exact fate of the cell, which takes a significantly large amount of time to understand, and how to deliver it surgically in a way in which there are less complications. So these are the two things that really, really make us stand out. And we hope our phase 2 will demonstrate that as well.
And what's the current status of phase 2, especially when it comes to approval in India? And how soon do you plan to file for an IND with the US FDA?
We hope to get approval for phase 2 in the coming weeks. It takes a little bit of time. There's a subject expert committee in India and so on. So that should happen in the next coming weeks. We aim to file for the US IND in June of 2026. Once we have substantial data available from our, of course, phase 1, but also a little bit of data available from phase 2 as well.
Sure. And, looking ahead, how do you envision Eyestem's platform evolving beyond eyesight RPE? Are there sort of plans to expand into other incurable diseases?
So that's an excellent question. So this is how we started, right? We said we want to get at incurable diseases with large patient populations. So our next step is a disease known as retinitis pigmentosa, which is a disease that affects kids. There you lose the photoreceptors. So that is our next step. There are other things also that are currently going on in the pipeline. The team can develop pretty much any cell of the body, and that's not the problem, right? I mean, we've grown beautiful lung organoids and brain organoids and all of that. How to productize those is where a lot of business comes in. So the idea is that over 10 years, as we start launching one product after another over time, we become smarter. And we become much more cost efficient, and that helps us provide affordable therapies for our patients.
Sure. And, if you could sort of take us through what the business model would then look like, right? Are you clocking any revenues currently? If you are, where is it at? And, what's the plan for this year?
So let's talk a little bit about the way business works. Is as it goes from phase 1, phase 2 onwards, you go on the hockey stick, which is normal. And just to give you a sense of the total market out there, dry AMD, the estimation of peak annual revenue for dry AMD, where you can reverse vision loss, is about $5 billion. So that's a large market, right? And there are two ways to do it. One is go commercial in India, which we are absolutely going to do. And the other is we're having conversations with people outside India to see if we should be licensing the therapy for them to take it through a milestone-based payment or take it ourselves. We're in no hurry because we have the capital now to make sure we make the right decisions.
So you have enough capital to make the right decisions. But, going back to eyesight RPE, right? It is designed as an allogenic, scalable cell therapy. How will this enable broader patient access both in India and globally?
So and the reason why we started is you start with the philosophy and the purpose of the company, right? The purpose of the company was address large diseases with scale. In an allogenic product, you can create a large batch and keep it frozen for 3 to 4 years, and the same batch can be supplied to a lot of patients. So that way, you automatically get a lot of scale, and that everything that we do goes through the purpose of creating scale, and I think we've made a fantastic start in eyesight RPE.
All right, Jogin, thank you so much for joining us on Startup Street. We're completely out of time, but we wish you all the best going forward.
Thank you for having me.
Well, with that, it's time for us to head into a short break. But coming up, DTDC has announced the launch of Raftar, a new quick commerce vertical promising deliveries within 4 to 6 hours through hyperlocal dark stores. Details when we come back. Stay tuned for more. Welcome back to Startup Street. As the demand for faster delivery surges in the era of quick commerce, logistics major DTDC has announced the launch of Raftar, a new vertical promising 4 to 6 hour deliveries through hyperlocal dark stores. The company is betting on what it calls rapid commerce or 4 to 6 hour deliveries, a space that is projected to become a $20+ billion GMV market by 2030. Shilpa Ranipeta caught up with Abhishek Chakraborty, the CEO of DTDC Express, and started off by asking him about the company's bet on rapid commerce. Listen in.
Whereas in the model that we are doing, which primarily is based on a concept called dark store as a service, which means shared fulfillment where multiple brands can keep their products in a dark store. And at the end of the day, we do very intelligent batching of orders in such a way that in a 2-hour or a 4-hour cycle, we can serve all the customers, which means in a single run of a rider, multiple products can get delivered. Right. So that brings down the cost for the the brands.
If you can sort of help me understand or elaborate a little bit on the launch of Raftar, where the ideas come from, that is very clear right now. But what exactly is it going to entail? And in terms of the cost to the brands, right, how is it better than what a regular DTDC or another logistic player like you would have offered otherwise?
Sure. So Raftar obviously is built on this fundamental premise, rapid B, smart B, and that means that we are finding that sweet spot. We are telling brands that you can come and work together with us in a shared fulfillment center where it's not just your SKUs, but the SKUs of other brands, non-competing brands that are kept together. We help you leverage that shared cost. You don't need to pay us anything upfront. There is no capital expenditure cost for the customers. Everything is pay as you go. Yes, the service charges here are slightly different from what we would normally serve. And the simple reason for that is we are not only charging for delivery, we are also charging for the storage and the processing, but everything is bundled into the price of the product. So when an order comes, we ship it and we deliver it, we pick, pack, process and deliver it, and that's the charge that you pay. But if you really think about it, the only premium that is being paid is literally for the fact that we're giving a faster delivery and the organization that's done for it. But otherwise, there is no super premiums that we are charging in terms of the way a customer is going to experience that product. And we are an enabler brand, which means we hope to see that at whatever price point we're doing it, it still makes it sensible for the D2C brand to retain their real margins and yet successfully get more and more customers. Because for a new D2C brand, they're not going to charge a huge margin. They want to attract new customers and offer this convenience at a reasonable price. And that's our main goal, the way we are doing it.
How are you sort of competing, and is Raftar like a response to that? And how have you seen the competitive intensity play out for DTDC?
I think we all know logistics has always been a very competitive market, but I think the competition is not necessarily an equal competition.
Right.
You have a lot of small players that are fragmented, regional, and the amount of unorganized component of the Indian logistics industry is massive compared to any other developed nation. We believe Raftar will obviously give us a competitive edge in terms of becoming more and more reliable, far better quality of service, getting deeper penetration for our brands. Otherwise, we see we've been very secure with our growth and the way we've been managing our business for the last 35 years. While there has been a lot of competition, but our growth trajectory has stayed very strong. Right. We have a very loyal customer base. We only hope to increase that customer base with Raftar. So yeah, I think there is competition, but we are quite comfortable and we think Raftar is going to be something great, not just from competition, but more from consumers who I'm sure would love what we are trying to offer to them.
Right. Wonderful. And what is your plan with respect to these dark store network or the dream store network that you're looking at building? If you can give us a sense, how many are you looking at establishing initially, what your targets are there rather, and how are you working on this batched delivery as well?
Sure. So we are right now already present in 7 cities. We've got more than 25 dream stores that are already live. In the next 2 quarters, we plan to enter another 30 cities, which is not just the remaining metros, but also go into some of the tier 2 and tier 3 markets. We're using a blended combination of our own existing network, our partners' networks, and then opening what we call at times shadow dream stores, which is interesting stores created strategically in order to cut down the timelines and make things faster. A lot of investment that we made on 2 parts. One is on the warehouse management systems that we're building, which is completely plug and play, making life very easy for brands to immediately put the inventory in. The other part is a lot of AI and machine learning that we're investing on in terms of route optimization for SLA adherence and all of that. What that means is over the next 2 to 3 quarters, we expect there to be at least 100 to 125 such dream stores, which are existing facilities as well as new ones that we're going to open up. Right. We expect to settle down for the first 1 year or so at about 35 to 40 cities and then see more and more deeper traction and penetration of customers within that. Of course, as this is a startup for DTDC, which means we're also learning along the way. Yeah. And I think we take it quarter by quarter and year by year. But at least for the next 2 to 3 quarters, this seems to be our plans right now.
Will you be able to tell me what this investment is into Raftar?
At this point in time, we're not separately calling out the investment only for Raftar, but yes, I can tell you that from about 100 crore capital expenditure that DTDC as a company did last year, we're doing about 150 crores capital expenditure this year. More than 55% of that is going into technology and, of course, into the processes and systems that we're building. We believe Raftar is at a very infancy stage right now. We don't need to separately call out investments for it. DTDC is well funded itself through its internal accruals. But as we go along, a year or 2 years down the line, we'll have a much better picture, and at some point in time, we are always open to take larger call in terms of how we want to grow and build it out.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching.